A profitable crude oil trader, months of consistent wins. One bad week, and the account was gone. This isn't a story about bad risk management or revenge trading. This is about something far more dangerous that almost every trader falls victim to. And if you're trading just one instrument right now, you're at risk. Today, we're breaking down the hidden danger of over-specialization, and more importantly, exactly how many instruments you should be trading to maximize your edge while protecting your capital. Here's what happened to this trader. For years, crude oil was his market. He studied everything: supply and demand dynamics, price action, OPEC meetings, inventory reports, seasonal patterns, geopolitical tensions. He knew this market inside and out. His A-plus setups had win rates most traders dream about. He was confident, consistent, profitable. Then the market regime changed. External factors started dominating price action: geopolitical events, unexpected policy decisions. The technical setups that worked for years stopped working. And here's where the real danger kicked in. Even though conditions had changed, even though his edge had disappeared, he kept trading. Why? Because crude oil was his only market, his only source of income, his only skill set. He told himself it was just a rough patch, that his edge would come back. But week after week, his A-plus setups kept failing. His account kept bleeding. The painful truth: when your only instrument enters a bad market condition, you have nowhere else to go. And most traders don't have the discipline to simply stop trading. Let's be clear about something. This trader wasn't an amateur. He had an edge. He had discipline. He understood risk management. But he had one fatal flaw: zero alternatives. Here's what most traders don't realize. Every market goes through periods where it's essentially untradeable for your specific strategy. Maybe volatility dries up. Maybe correlations break down. Maybe external noise drowns out your technical edge. When you only trade one instrument, you face three critical dangers. Danger number one: forced participation. You have no alternative markets, so you're forced to either take suboptimal trades or sit out completely. And sitting out feels like failure. It feels like wasting time. So you convince yourself that mediocre setups are actually good ones. Danger number two: lost objectivity. When all your focus is on one market, you develop tunnel vision. You can't step back and say, this environment isn't conducive to my strategy right now. You're too close to see clearly. Danger number three: psychological collapse. When all your trading identity is wrapped up in one instrument and that instrument stops cooperating, it destroys your confidence. You start questioning everything: your strategy, your analysis, your ability as a trader. And that's when you make catastrophic decisions. Jesse Livermore said it perfectly. The game of speculation is the most uniformly fascinating game in the world, but it is not a game for the stupid, the mentally lazy, the person of inferior emotional balance, or the get-rich-quick adventurer. Even the smartest trader becomes emotionally unbalanced when trapped in one market that's turned against them. Now, here's what you need to understand. This isn't about abandoning specialization. Deep market knowledge is valuable. Understanding a market's personality, its patterns, its quirks, that's a real edge. But you need options. Think about it like this. Imagine you're an expert deer hunter. You know everything about deer behavior: migration patterns, feeding habits, best locations and times. You're incredibly skilled. But what happens when deer population crashes? Or disease wipes them out? Or regulations change? If that's your only skill, you're done. But if you also know how to hunt elk and turkey, suddenly you have choices. You can hunt what's most abundant. You're not forced to hunt deer in terrible conditions just because that's all you know. Trading works exactly the same way. After that crude oil trader's experience, he made a strategic decision. He added two more instruments. Not 10, not 20, just two: natural gas and gold. Why these? Because they shared similarities with crude oil in terms of price behavior and setup types, but they weren't perfectly correlated. They had their own personalities, their own drivers, their own rhythms. This gave him something crucial: selectivity. Instead of forcing trades in crude oil during poor conditions, he could shift focus to whichever market was offering the best setups. He could trade opportunities with the highest expected value rather than trading out of boredom or desperation. The result? His overall performance improved dramatically. Not just because he had more opportunities, but because he was taking better opportunities. He was more patient. He could wait for true A-plus setups instead of talking himself into B or C grade trades. The psychological shift was massive too. When crude oil went quiet, he didn't panic. He just looked at his other markets. The pressure was off. His trading became more objective. So here's the critical question. How many instruments should you trade? The answer is between 2 and 3. Here's why. One instrument, too much risk. No alternatives, no flexibility. Too much pressure on that single market to always cooperate. 2 to 3 instruments, the sweet spot. Deep knowledge of each market, but flexibility to rotate focus toward the best opportunities. You're selective and opportunistic. 4 or more instruments, spread too thin. You won't know any of them intimately enough to recognize optimal conditions versus poor conditions. You'll miss subtle shifts. You won't develop that sixth sense about true A-plus quality. Bruce Lee said, "I fear not the man who has practiced 10,000 kicks once, but I fear the man who has practiced one kick 10,000 times." In trading, don't practice 10 markets casually. Practice 2 to 3 markets deeply. You need to be intimate enough with each market to know when it's in a high probability environment versus a low probability one. That only comes from focused attention and repeated observation. If you're trading just one instrument right now, here's how to choose your additional markets. Criteria number 1, strategy alignment. Choose instruments that fit your existing trading style. If you're a momentum trader, don't add range-bound markets. If you trade mean reversion, don't add instruments that trend relentlessly. Leverage the skills and pattern recognition you've already developed. Criteria number 2, low correlation. Choose instruments that aren't perfectly correlated with your primary market. You want diversification of market drivers. Trading crude oil, add currency pairs or gold. Trading tech stocks, add commodities. The goal is to reduce the chance that all your markets enter bad conditions simultaneously. Criteria number 3, sufficient liquidity. Make sure these markets have enough volume for your trading style. Thinly traded markets will eat you alive with spreads and slippage. Criteria number 4, time to learn. Start small. Don't immediately trade new instruments with full position sizes. Spend 3 to 6 months learning their personalities, study them, paper trade them, understand their drivers. Only add them to your real money rotation when you can recognize optimal conditions versus poor conditions. Here's how to actually implement this without screwing it up. Rule 1, don't trade every instrument every day. Some days, only one market will offer quality setups. That's fine. Take that one trade and be done. Quality over quantity, always. Rule 2, divide attention intelligently. Spend 60% of your prep time on your primary market, 20% each on your secondary markets. This keeps you deeply connected to your main instrument while staying aware of opportunities elsewhere. Rule 3, journal separately. Keep separate journals for each instrument. Track your trades and your observations about market conditions. Over time, you'll develop a feel for when each market is tradable versus when it's better to stay away. Rule 4, consistent risk management. Your risk per trade should be identical across all instruments. Don't risk more on your favorite market or less on new markets. Treat them equally. This prevents overtrading your comfort zone and undertrading your opportunities. Rule 5, quarterly reassessment. Every 3 months, analyze your results. Are you actually more selective, or did you just give yourself more ways to overtrade? Are you rotating toward quality or trading more overall? Be brutally honest with yourself. Let me warn you about the traps that kill this approach. Trap 1, adding instruments as an excuse to trade more. If your total number of trades goes way up after adding markets, you're doing it wrong. The goal is better selectivity, not more activity. Trap 2, abandoning your primary market too quickly. Rough patches are cyclical. Don't give up on your main market just because it goes quiet for a few weeks. Stay aware. Keep tracking it. Be ready when conditions improve. Trap 3, adding too many instruments too fast. Master one additional market before you think about a third. Rushing defeats the entire purpose. Trap 4, using multiple instruments to hide from a broken strategy. If your core edge is gone, trading other instruments won't fix it. Make sure your strategy is sound before you expand. Here's the bottom line. That crude oil trader learned this lesson the hard way. Watching his account get destroyed while he stubbornly refused to adapt was brutal, but it taught him something invaluable. Specialization and flexibility aren't opposites, they're complementary. You can be a specialist in 2 to 3 markets. You can have deep knowledge and strategic options. You can be both expert and diversified. The key is finding the sweet spot where you know your markets intimately, but you're not trapped by them, where you can be selective about only taking the highest quality setups, regardless of which instrument they appear in. So here's your action plan. If you're trading just one instrument, identify one additional market that fits your strategy and style. Spend the next 3 months studying it, learn its personality, understand its drivers, paper trade it. Then, slowly, carefully, add it to your rotation. You don't need 10 markets, you don't need 20. You just need enough options to protect yourself when your primary market inevitably goes through a rough patch. Because those rough patches will come. The question is whether you'll have alternatives when they do, or whether you'll be forced to trade suboptimal setups while your account bleeds out. Choose wisely. If you found this valuable, hit that subscribe button. We're building the most comprehensive trading education channel on YouTube, and we drop new videos every week on risk management, psychology, and strategy development. Drop a comment below. How many instruments are you currently trading? Are you over-diversified or under-diversified? See you in the next one.